Having some technical difficulties here. Is it still doing it? Okay. All right. Hello, everyone. We've got a nice mix of people. So we're in person here. I'm like bending over because Ruby's a lot smaller than me. So we've got an audience here in person, then we've got some people on Zoom, and then we've got a bunch of people on Facebook. So no pressure, but we have Ruby here. She's actually one of our fellow colleagues. She's an agent here at Century 21 Percy Fulton, but she's also a tax specialist with 360 Global. So she's kind of bringing in her knowledge from both sides of the industry. She has spoken for us before, so some of you guys may have heard her in the past, but we have had some changes with the foreign taxes. So we thought it'd be a good time to kind of introduce it to you guys, whether you're working with foreign buyers or not. It's always kind of nice to just have that extra knowledge for your clients. So yeah, if you guys have questions throughout, she has a presentation that she's going to do for us. If you have questions, do you prefer them at the end or during?
I'm going to try to make it collaborative because
Okay.
tax is never so fun to talk
Yeah.
about, but I'm going to try to make it fun.
Perfect. Yeah, very riveting topic that we love. So if you guys have questions, Carly and I will be in the chat. I'll be on Facebook. Carly will be on Zoom. So if you are tuning in virtually with us, we will relay the questions to Ruby. And then if you're in person with us, then just shoot up your hand and ask questions as we go. So I will get started. Do you want me to put your PowerPoint on right away? Awesome. And we will present. Let's see, I think you can see it. Awesome. I'll put everyone's heads down here so it doesn't distract you. There you go. All right. All you, Ruby.
Perfect. Hi, everyone. Thank you so much for having me here today. It's been a few years. My name's Ruby Jahan, for those of you who do not know me, and I'm co-founder and VP of 360 Global Tax Professional Corporation. 360 Global Tax Professional Corporation, who we are. Oops. Sorry, I have to move this. Okay, perfect. Do I show up on the screen too?
There you go. Yeah, you're in like a little corner.
Okay, perfect. And I'm sorry. How do I go back?
You can use the, yeah.
Sorry about that, everyone.
She's using my computer today.
First time. So 360 Global Tax, who we are. We are a boutique Canadian tax firm specializing in international tax matters for Canadian expats and non-residents. So we assist everyone outside of Canada with Canadian tax implications and those who are planning to leave as well. So with pre-departure and post-departure tax implications, such as when do you become a non-resident of Canada? What does it mean when you're a non-resident? What does it mean for your tax filing and withholding requirements? We also assist with tax preparation, and we have a dedicated realty tax division as well. There's a lot of non-residents and Canadians living across the world who keep their Canadian real estate or turn it into rental property or continue to invest in Canadian real estate, and they have special tax requirements when they live outside of Canada. And we at 360 Global Tax, we believe in a personal approach no matter where in the world you are. You want to know who you're working with and trust the experts you're working with and that they're available to you, no matter if you're in Dubai, Australia, wherever. So our tagline is actually, we believe in a personal approach. So today we're going to talk about Canadian tax implications. And most of the time when you really don't have to think about tax, nobody wants to think about tax. Tax is not often a fun subject, but it's very crucial to each real estate transaction, especially if you are buying rental property, selling property, if you're an investor for real estate purposes. So the first question that often comes to mind is how to determine if someone is a non-resident of Canada for tax purposes. And unfortunately, there's no clear answer to this. You know, you can look it up at the Income Tax Act and it'll talk about primary ties and secondary ties, such as where you own property, where do you live, etc. But in today's day and age, the world is so global. People live in multiple countries. People have homes in multiple countries. They have businesses set up in multiple countries. So there's no black and white answer, and each individual situation is very specific. So it has to be reviewed by an accounting individual. And one thing I would mention is sometimes there's a questionnaire called NR73 that people recommend filling out. We never recommend filling this out. It's just a questionnaire for CRA Canada Revenue Agency to give their opinion. So it can actually be wrong. So imagine the CRA, the actual government tells you their opinion and it turns out wrong, but it's up to you to file the correct tax returns. And if you don't file the correct tax returns or do the correct items, you could have penalties. So talk to an accounting professional to determine when you actually became a non-resident, what needs to happen, etc. So non-residents who own Canadian rental property. This could be someone who's moving from Canada and they decide to keep their Canadian property, but now they want to list it for rent. So they come to one of us here at Century 21 Percy Fulton and they say, hey, I'm moving, I'm going to turn it into a rental property. Do you know if I need to do anything? The answer is yes. When someone owns rental property, there are specific tax withholding and filing requirements. So the way the CRA works for non-residents is actually a little bit different. There's a few different divisions involved. One is called the individuals division. That's where we all file tax returns. It's associated with our social insurance number. Then there's actually another division called Part 13 and non-resident tax. And this division, it looks after rental income, pension income, investment income, whatever sort of income. And it just wants to make sure tax is paid upfront in case someone leaves, lives wherever, and they don't file tax returns to report their actual income and pay a final tax obligation. So CRA makes it a little bit of a convoluted process where people have to pay tax upfront, wait to file tax returns, and then get some money back. So the first option CRA gives, which is the default option to withholding tax, is to pay 25% of the gross rent every single month. Most people don't want to do that, especially if you have mortgage payments, property tax bills, etc. You don't want your money tied up with CRA and them just hold it for over 1.5 years until you file a tax return. But I do have to go through this option. I would say less than 5% of people go with this. They can set up their own non-resident account or have a third party to withhold tax on their behalf. Essentially, they're paying 25% single month. It's held with the CRA, and then they can file a tax return later on to get it refunded. The second option, which is the NR6 form option, which I would say 95% of individuals with, it allows the taxpayer to pay a lot less tax upfront based on reduced tax withholdings. So essentially what we do is we prepare almost like a estimate tax return and we submit it on behalf of our client, and CRA allows them to pay 25% of the net. So imagine if your client's estimating a loss position, they're estimating more expenses than income. They can end up paying $0 in tax upfront to the CRA. To submit NR6 form, you must have a third party, such as an accounting firm, who's registered as a tax withholding agent. We recommend using an accounting firm because technically there are realtors and property managers who do this, but unfortunately there's so many liabilities that they often get penalties and then they end up coming to our accounting firm to fix it up. So as a realtor, if you do ever decide to act as a Canadian tax withholding agent, there's a lot of penalties, payments, tax filing deadlines, which we'll go through as well. So the NR6 form, it has a strict tax filing deadline and until, sorry, let me backtrack. So it has a strict tax filing deadline of June 30th. And that's because CRA allows the taxpayer to pay less tax. So the tax return must be filed by June 30th. And if the taxpayer fails to file the tax return, the penalty is 25% of the gross rent plus arrears interest, because CRA wants to be paid if there's any tax owing. So until such time this NR6 form is filed, the taxpayer has to pay 25% to the gross rent each month as tax. The benefit of the NR6 form is the taxpayer can pay a lot less upfront. So essentially, part one, NR6 form is submitted, it's approved, the client's paying his little tax upfront for the year. Then part two, they receive an NR4 slip once the year is over, pretty much a non-resident tax slip, where the Canadian agent who withheld the tax on behalf of that individual has to prepare this. It's almost like a T4 slip. It'll say the name, an exemption code that the client was allowed to pay less tax because they had an NR6 form, and the taxpayer's details. Part three, I want to go over deadlines and penalties. So when someone withholds 25% to the gross rent every single month, CRA does not have a strict tax filing deadline. They actually give the taxpayer 2 years to file the tax return. And then once the tax return's filed, that taxpayer's taxed on the net income and refunded any tax. So essentially, CRA doesn't have a strict tax deadline because they're probably holding that money in a bank account. It's probably earning interest somewhere, and that client's always going to be in a refund position. Now, if someone files the NR6 form, like I said earlier, June 30th is the deadline. It's a very strict deadline. And other deadlines include paying tax withholdings by 15th of each month. And if there is a final tax liability, it's due by April 30th. So if someone does act as a Canadian agent, there's late payment penalties, NR4 filing penalties, late payment penalties for the NR6 form, and also the 25% gross rent plus arrears interest penalty. What the CRA does is if the taxpayer doesn't file the tax return, they're living anywhere in the world. So CRA goes after the person who signs off on the NR6 form, like the accounting firm or the realtor or the property manager. And we have situations where, let's say a client doesn't file a tax return, the realtor isn't aware for 2-3 years. They get a notice from CRA saying, hey, your client didn't file a tax return, you owe us $10,000. And if you as a Canadian agent don't make the payment, CRA can actually go into your personal bank account. And this has happened to my client who used his mom, and now his mom got $11,000 taken out and penalties for 2 years of failing to file tax returns. And we're trying to go back and hopefully get at least half of that back, you know, really plead a case that it was his mother, he didn't know, he's a non-resident, et cetera, et cetera. Now, does anyone have questions about rental income tax withholding and filing requirements I just talked about?
The NR6 form, right?
Yeah,
You have to fill that at each month or at the end of the tax.
that's a good question. It's filed every single year, so it has to be approved every single year for the taxpayer to pay less tax. And if the NR6 form is not filed, it goes back to the default 25% gross rent withholding. And also the Part 13 and non-resident division, their penalty for failing to withhold tax is 25% to the gross rent plus arrears interest. So the technical wording in the Income Tax Act says the payor of the rent is responsible, which in theory, the tenant really isn't responsible for the owner's tax payments, tax withholdings, right? But if it was a property manager or a realtor handling that, because they're a professional, they would become responsible, and the CRA might go after that person for failing to withhold 25% to the gross rent.
So you have to know like who's a resident, who's a non-resident, and act accordingly as like a realtor. Is that-
Like, no, but your client, like if you're working with somebody who lives overseas,
Oh,
I would assume already, hey, you live overseas, you
Yeah.
probably have some special tax requirements. Talk to an accounting firm, figure it out, because you want to comply, because if you fail to withhold tax, the penalty is 25% of the gross rent plus arrears interest. And what happens is, let's imagine someone's been gone for 5 years, they just didn't know that they had to withhold tax, or maybe they withheld 1 year and they decide to stop. Often what happens is when someone sells Canadian property, CRA has to be informed. That's the opportunity for them to look into that client's file and say, oh, you were earning rental income, why wasn't tax withholdings done? If it was an honest mistake, potentially you could file tax returns, ask for forgiveness, and CRA can forgive. They do forgive once in a while. But if the taxpayer was aware and they did withhold tax and they decided not to, maybe they switched property managers, maybe they switched accounting firms, then they're going to get that 25% gross rent penalty for sure, plus arrears interest. Yeah. Any other questions on this? Yeah, so like, you know, if you're earning rental income as a regular Canadian tax resident, you just have to file it on your tax return every year. But because you're a non-resident and you live overseas, CRA wants to make sure they get paid up front. Yeah. Sorry, 1 second.
You said non-resident,
Mhm,
Canadian, who works, say, in the US.
mhm. Yeah. Yeah.
What do you consider that?
So,
That he's renting the property that period of time.
yeah,
How do they have to?
as a,
Resident tax or non-resident tax?
The owner?
Yeah, the owner.
yeah, so if someone's a non-resident of Canada, then they're required to withhold tax, the way we just talked about. Yeah, are you asking how do you determine if
Yeah,
someone's
how
a
do you-
non-resident?
how do you determine that?
Okay, so we gotta think, so there's two ways to think about that. One is immigration status and one is tax status, right? So immigration, let's say you're a Canadian citizen, permanent resident, etc. That's treated differently than tax status. Non-tax status is if you're a non-resident of Canada for tax purposes. If you're a tax resident of Canada for tax purposes, you can also be a deemed non-resident and a deemed tax resident, which is another situation where potentially you're working across the world for United Nations and you don't have special tax rules. But to determine if you're a non-resident of tax for tax purposes or not, your situation has to be looked at by an accounting person because there's so many different things that could be happening in different countries, right? And technically you can only be a tax resident of one country. So let's say you live in two countries, you're a tax resident of one and you're going to be a non-resident of the other one for tax purposes. So generally speaking, if your whole life is abroad and you live, work, and your family has moved, we'd have to look at it specifically, but I would assume you're probably a non-resident at that point because you've lived overseas. Yeah. It's not black or white because everyone's situation is very, very different. But let's say your whole life is abroad and whatever, you having a Canadian property or having some things in Canada doesn't make or break your tax residency status. So let's say you're a non-resident for tax purposes, you live overseas, but you have 4 Canadian properties. That doesn't make or break your tax residency status. That's just another way of earning income from another country. So someone can be a non-resident of Canada, but still, let's say, work for a Canadian company, do some contract work, but still have their whole life elsewhere. So it's so particular and everyone's situation is so different. So it could also be the opposite, that someone could potentially live somewhere else most of the year, but they're still a tax resident of Canada. So each individual situation has to be looked at specifically.
There's a question from Zoom.
Mhm.
What happens if the property in a joint venture with the parents, but the son is living in the US and working? Again, it's another unique case.
So
I think.
so the way CRA sees ownership, let's say if there's 2 owners, even 3 owners, let's say there's 3 owners, each owner owns 33%, 0.333, whatever, right? Each owner owns 33%. One owner is a non-resident, and that's a rental property. So for that non-resident, for his share of ownership, he's required to withhold and report his income for his share. So everyone's ownership is done based on their share. Yeah. So for example, we have situations, and I'll talk about this a little bit in the sale of property, but we have situations where there's divorces, transfers between brothers and sisters of property and things like that, which is a whole different situation we're going to talk about right now. So non-residents who sell Canadian property. If you're a tax resident of Canada selling Canadian property, it's much easier and you just usually report the sale on a tax return, whether it's a capital gain, business income, or it was your principal residence without any tax requirement. However, as a non-resident of Canada, there's a certificate of compliance and a non-resident tax return requirement. What this means is the certificate of compliance application, it's an application that calculates 25% of the net capital gain, if any. It has to be filed within 10 days of closing, or the penalties per taxpayer are up to $2,500. At the same time, the lawyer is required to hold in trust 25% of the proceeds. So if someone's selling a property for $1 million, 25%, $250K is held with the lawyer. We don't want the lawyer to send any money to CRA because it can take an extremely long time to get it back, and 25% is a huge chunk. So we work with the CRA to issue a letter and say, hey, lawyer, hold on to this money until we ask you for some money. Lawyer's holding on to the money. CRA asks for a payment. They're processing the applications. They send a letter to our office. We coordinate with the lawyer, and that payment will be 25% of the net capital gain. That payment's made from the money the lawyer's holding in trust. Once CRA issues a certificate, the rest of the money the lawyer's holding can be released back to the client. 2 caveats on that. One, if you need that money to buy another investment property or you need to pay off your mortgage, you're going to have to think about possibly bridge financing or loans or something like that, because the lawyer is going to hold 25% no matter what, as per the Income Tax Act. Caveat 2, It takes a CRA about 6 months to process certificates. So that means that the money's held with the lawyer for up to 6 months. It's a huge chunk. And for rental property, I have to disclose this, but I would say it only happens out of like 1 out of 100 times. For rental property, lawyers can actually request 50% of proceeds be held in trust. So imagine you're selling something for $1 million, 500,000 held in trust. That doesn't normally happen because it's an insane amount. I would say the only time it really happens is when a buyer's lawyer is really worried. What we normally do is share the applications so it can show any tax liability and ease any concerns, because even 25% gross proceeds will likely never be the amount of tax the individual has to pay upfront to issue the certificate. So, sorry, a lot of tax talk. Yeah, so that's part one. Part two is filing the actual tax return. So the following year, they have to file a non-resident Canadian tax return. And on that tax return, only 50% of the capital gain is actually taxable. You know, capital gain always sounds really scary to everyone, but at the end of the day, it ends up being a lot lower. And they're happier with the final amount, even though, you know, they're not too happy to pay tax. But so on that tax return, 50% of the capital gain is taxable, and also selling related expenses are included, which is realtor commission, legal fees, accounting fees, etc. And it'll bring down that capital gain even further. So imagine closing fees or closing costs are about 30, 40K. It'll bring down that cost. And we'll go over an example calculation. So once that tax return is processed by the CRA, the taxpayer gets a pretty hefty refund because CRA collected way too much tax at the time of the certificate. Also, if you do sell property in Quebec, there's additional filing requirements and tax withholding requirements of an extra 12.87%. Quebec has Revenue Quebec in there, so there's filings for CRA and Revenue Quebec. I'm going to go over a sample calculation, and then we can go into some questions on this. So here you'll see a breakdown of calculation for the certificate of compliance and then also the non-resident tax return. So assuming this person bought a property in 2016 for around $816,500, they spent about $25,000 on capital improvements and other things. That helped, that adjusted their cost base to $841,500, meaning initial purchase price plus any improvements spent on the property and purchase costs. Now they're selling the property for $1 million. There's been a capital gain about $158,000, $158,500. Sorry. And let me backtrack. Actually, I'm going to explain this better. I apologize. So many numbers. Okay. They bought it for $816,500. There were all these improvements, and now they're selling it for $1 million. So what that means is at the time of sale, lawyer's going to hold on to $250,000. They're going to get the remainder back, $750K. Lawyers holding on to $250,000. The capital gain was $158,500. So CRA is going to want 25% of that capital gain to issue that certificate. That payment's going to be $39,625 from the 25% of $250K the lawyer's holding in trust. So after the $39,000 is paid and CRA issues a certificate, the lawyer can release the rest of $211,000 or so back to you. Yes.
So we calculate the capital gain, what it would be like on hand, like when you're about to like sell your property, like the lawyer knows like what you purchased it for. And what
It would be a rough calculation. Like what we do is we ask to be engaged about 30 days before. We work with the realtor, the lawyer, the client, and we have to gather the purchase documents, sales documents, capital improvement receipts, also fair market values of different items. This is a simple calculation, but there's various calculations because let's say it was a principal residence for 15 years. That means there's going to be a principal residence exemption for a portion. Then there's going to be a capital gain for the period it was a rental property. So it's not so straightforward. Let's say if someone lived in the property as their principal residence and they're selling it and they're still in Canada. That means there's no tax because there's a principal residence exemption. But If at some point the change of use switched from principal residence to rental property, CRA is likely going to take the fair market value of when it turned into a rental property as the cost basis, meaning the purchase price. But there's other elections and other things that can be filed to help defer capital gains as well. I'll touch on that shortly. So just to get back to this, so let's say they paid the 39K, 210K is back to them. Great, they have their money back. The following year on the tax return, capital gain was about 158,500. They had selling expenses of 60,000. Now their capital gain is much less. It's about 98,000, and only 50% of that's going to be taxed. So at the end of the day, their total tax they're paying is about $12,000, and they're going to be refunded close to 27,000. So you can imagine at the beginning, it seemed like very, very big numbers. They have to pay this whole large amount to issue the certificate. But at the end of the day, with half the capital gain, with the selling related expenses, they're really only paying about $12,000 on about $160,000 capital gain. So this is one calculation. Like I mentioned, there's various calculations available depending on different elections that are filed, depending on how long the property operated as a rental property versus principal residence, etc.
Question.
Yes, let's go. Now, I know I said a lot. There's a lot of numbers, a lot of processes there. I'm happy
Can
to
you
go
back
over.
The, previous
Yes.
numbers.
Yes.
The purchase price was 816,500
Mhm.
from 2016.
Mhm.
Then they're doing the tax in 2020 for them. I mean, end of the day, so 2016 tax, they have to do the tax return on 2017. The improvement of $25,000.
Yeah.
Will they be using that as a
Expense?
on
There's a-
that year?
This is a good question. Let's talk about expenses for a second. So when it comes to owning a rental property, let's say, almost everything related to your rental property is tax deductible as an expense, except for vehicle and travel because of special rules. So thinking about expenses, mortgage interest is usually one of the largest expenses. The mortgage principal payment, obviously that's money going back into your own pocket, but for interest, it is tax deductible. So a lot of investors right now, they don't care too much about the interest rate because it's a write-off anyways at the end of the day. Property taxes, insurance, accounting fees, leasing fees, legal fees, maintenance and repairs. Now, when we talk about maintenance and repairs, there's two different ways to look at these expenses. One are considered current expenses and another capital expenses. Current are those that you report on your tax return every year, like property tax bills, condo fees, etc. Then there's capital expenses, which are considered long-term in nature, such as replacing floor, roof, etc. There's a number of different capital asset categories with different depreciation rates. And normally at our tax firm, we don't recommend taking depreciation, which is I think what this gentleman's talking about. Depreciation is when you can get a little bit of a tax advantage for your capital improvement throughout the year, depending on the tax rate. For example, one of the asset classes might have a 4% depreciation, meaning you get 4% advantage of having that capital improvement and depreciating through the year. However, we normally don't take depreciation on improvements because that cost has to be added back when you sell your property. So you end up paying more tax on the capital improvement when you sell the property because you're at a higher tax bracket with all the income versus reporting it on the rental tax return and taking the deduction there at that point. So depending if it's beneficial to you or not to take that deduction, we would at our accounting firm. So we'd have to look at it in your situation. But another thing to consider is when sometimes people take, it's called CCA depreciation, it can nullify elections that you filed with the CRA to defer capital gains. So for example, and this is a tip for everyone, there's different elections that can be filed when you change your property from a principal residence to a rental property. So let's say you yourself live in a property, you changed its use. There's something called a 45-2 election. And when you live in Canada, it can defer the change of use for 4 extra years. Meaning, if you sell your property within those 4 years, but you don't live in it anymore, you don't have to pay tax on the capital gain. So that's called a 45-2 election. It's really important to know. However, if you take depreciation and CCA on your tax return, then that election becomes nullified and you do have to pay capital gains from its purchase.
This for Canadians?
This is for Canadians, but when you become a non-resident, you can file it too, but I believe you might get a 1 year extra because when you have a principal residence, there's a +1 rule. So let's say it was your principal residence, you leave Canada and you sell it the following year. That +1 year rule allows you not to pay capital gains for that 1 year. Yeah, there's a few different ways, different elections. And that's why if you are changing your property from principal residence to rental property, you should speak to someone to determine if that election is going to be beneficial to you or not. Because depending on how the fair market value and the rental market is going, maybe your capital gain is higher right now, or it's lower depending on the current fair market value. Yeah. Yeah. Yeah, so there's something called a 45-2 election. Yeah, 45-2 election. You can file it with your tax return the year you change its use from principal residence to rental property. And you file alongside your tax return. And if you're a tax resident of Canada, it defers capital gains for 4 extra years, up to 4. Yeah.
Can you do it the year after?
You can file a late filed 45-2 election, but there's penalties, and I believe the penalties are up to $8,000. So the interesting thing is sometimes you can't really tell if you're getting a benefit or not until you finally sell the property, depending on the fair market value
So like who
in
would
the
I talk
year.
to? Instead of talking to someone, would that be the accountant?
Yeah, you talk to our accounting firm and we would figure out, depending on if you're changing the use of property. If you,
Our brains, he's texting me right now. I'm texting my husband right now. I'm like, you need to sell.
yeah, for the year on the tax return.
Yeah,
Yeah, yeah. I wake up out of my sleep and talk tax, guys. So I talk tax all day. This is memorized in my head. I've been working with non-residents close to 10 years. At large international tax firms as well. And our clients are everywhere in the world, Australia, Dubai, etc. And when someone owns rental property, it's not just a one-time tax return. You have to touch point multiple times with your accountant, because NR6 at the beginning of the year, NR4, tax return, selling property, whatever it is. So a number of things need to happen. It sounds like a lot, but once we, have everything in place for you, it becomes habitual. And most of the time when you're a non-resident, let's say if you are an investor and rental property owner, it's every year almost the same filing. So they become familiar with the process. And we try to help our clients to pay as little tax as possible, be as tax efficient, report as much as possible, of course. So the next thing I'm going to talk about is GST, HST, new residential rental property rebates. So we all know pre-construction is huge, especially in Toronto. God knows the hundreds, maybe close to 1,000. I have no idea in Ontario, pre-construction buildings going up. And many of these buildings, units are bought by investors, turning these units into rental property. So when someone buys pre-construction, it is a commercial transaction because it's sold by the builder to you. There's 2 different rebates available. One is called the GST, HST, new residential property rebate, and another one if you live in the property. If you're buying a pre-construction unit to live in, usually the builder will apply for the rebate on your behalf and taxes incorporated into the price. However, if you're not an end user and it's not going to be your principal residence, whether you plan to leave it vacant or turn it into an investment property, there will be a tax requirement at closing. So when you buy investment property, there is something called the new residential rental property rebate that you can file within 2 years, and you can get a lot of your tax rebated. So once the occupancy closes, once you have a tenant in place, within 2 years, you can file this rebate and you can get refunded back up to $24,000 of the provincial portion and up to $6,300 of the federal portion. However, to qualify for the federal portion, the property value has to be $450K or less. Now, in today's day and age, most properties are over this, so the taxpayer will still be eligible for the $24K rebate. And what we do is we work with the CRA, we submit a hefty package showing all the documents, and the CRA should refund the rebate within about 3 to 4 months. And that can be deposited directly into the Canadian individual's bank account. Yes.
Do you have to get a appraisal to show the value, or can you get a realtor to just show what like the sales have been to prove to CRA?
For that, what we do is we send the initial purchase documents and then also the closing documents at the time of closing, leasing documents, etc. They should agree with the original purchase cost. It's interesting. So in the rules, as per CRA, as per the wording, it says it should be based on fair market value. But we know as realtors, when someone buys a property 5 years ago, maybe they bought it for 450K and now it's worth 800K. And at our firm and my previous firm as well, we submitted based on the original documents without supplying the fair market value. We don't want to give inflated numbers unless they really ask us for those numbers. And I haven't had a situation where they've asked for fair market value and they have accepted the rebates based on the original purchase price, and it hasn't been an issue. Because the concern, which I get concerned about it as well, is if someone bought it at 450K and now it's worth 700K, that means that they're supposed to pay tax at the closing worth 700K, which means, if CRA comes back and they're saying that the closing value is worth 700K, they're going to ask you to pay more money, right? So I haven't seen that happen. It says it's supposed to be like that per the Income Tax Act, but in theory, they've just been processing it as the actual closing numbers and purchase price. Yeah.
Sorry again. Federal portion is, purchase price, the value is 450,000.
Yeah.
Not the provincial, is it any amount?
There's no amount for the provincial portion.
So we get to 24,000 for 11.
Yeah. Yeah. The federal portion, not so much. But yeah, and there's in this rebate, there's different forms for federal portion of the rebate, provincial portion of the rebate, etc. Have any of you guys come across investors and helped them with this rebate or anything like that? Interesting. I think actually just talking about the rebate is very interesting. I would have assumed that builders advise people of these rebates. I've come across non-residents that had no idea, and they've owned a property for 3 or 4 years and they're missing out on close to potentially 30,000. And it's shocking to me because like our firm helps with this. And I'm just trying to connect with as many individuals because 30,000 is huge and people just don't know.
It's usually the lawyer who like got it.
And the lawyers don't tell you anything.
The lawyers don't, yeah. So that's another thing. So, we work with realtors. We're really here and available. You need to have a team of great lawyers, great accountants, whether they're for local individuals or non-residents. When someone comes to us, we always have an initial call. We're not going to charge you $300 per hour just to have a discovery call. We have a conference call with the realtor, the client, figure out their situation, next steps, and hopefully they will work with us because we're the experts. But if not, at least they got some value out of the call and they have a better understanding of their situation.
The time frame for that.
2 years from occupancy,
And I would assume a real estate lawyer, we know that because.
but they might not be proactive. That's the problem a lot of times, that they just, unless you ask, sometimes people don't tell you anything unless you ask them, right? But then how are you supposed to know?
You don't know what you mean?
Yeah. Yeah. So we have a few new taxes outside of the Income Tax Act in Ontario and Canada. So we have a foreign buyers ban, yay, which I think we needed here in Canada, especially Ontario. There's a lot of investment properties sitting vacant where money is just being funneled. And this foreign buyers ban, it's going to be in place for 2 years starting January 1st, 2023. It applies to properties with 3 units or less. Properties with 4 units or more would be considered commercial, so it's not included in this. This ban prohibits non-Canadians, and what non-Canadian means in the eyes of the government is, excuse my spelling mistake there, who's not Canadian citizens, who are not permanent residents of Canada, foreign corporations, or corporations controlled by foreign corps or individuals. There are exemptions for refugees, spouses of Canadian citizens, students who are working here. And if you as a realtor or any individual accounting firm helps a non-resident purchase Canadian real estate and be a little tricky or anything like that, there's a penalty of $10,000. So it's just not worth it. Like if you have someone who's a true foreigner, no ties to Canada, doesn't come to Canada, never files tax return, anything like that, maybe advise them for 2-3 years down the road. But in my experience and in my opinion, I honestly don't see that many true foreigners. Usually it's Canadians or people who plan to come back to Canada, move for a little bit, investing back into Canada. And those Canadians usually are not greedy. They want to provide housing. They want rental property. They also want to earn rental income. So the whole purpose of this foreign buyers ban is to prevent people who are not really using the property, where Canadians, we might come back into Canada, we might give it to our kids, we might give it to our family, we might want our own real estate portfolio. So it's really for those foreigners. Other property taxes and items to consider. So as we all know, City of Toronto has a vacant homes tax coming now, and which has to be declared by February 2nd, 2023. And failing to declare it, they'll automatically assess your property as vacant unless you tell them. And the assessment will be 1% of the assessed value for the year. The property has to be occupied for 6 months in total, whether it's the homeowner as their principal residence, whether it's a permitted occupant like their family or child, a tenanted property, or if there's eligible exemptions like repairs, death, transfers. But another item to note is these vacancy taxes are popping up across Canada. BC has vacancy taxes in Vancouver. I believe Ottawa might have vacancy taxes soon. And really it's because we don't want vacant properties which cause the rent prices to keep going up. We want to have available housing to people who are actually here. As we all know, the rental market can be crazy, rental prices are crazy, and the government wants it to be a win-win situation for everybody. Other taxes to consider: Toronto has a short-term rental operator tax, which you must sign up with the City of Toronto. It's 4%. Airbnb rules in Toronto, it must be your primary residence. And talking about Airbnb, so if someone has a short-term rental operating business, Vrbo, Airbnb, etc., there's GST, HST considerations. And if you make over 30,000 in any 12-month period, not 1 year, but 12-month period, meaning even March to March, you have to set up a GST, HST account and start remitting tax. If it's under 30K, a lot of these companies like Airbnb and Vrbo will remit tax on your behalf, and you may not be required to open up your own GST, HST account. Thank you, everyone, for having me present in here. I know I said a lot about tax. Tax is exciting for me. I work with individuals across Canada. And if you guys have any questions, please let me know.
Do you work with Canadian residences or the regular taxes?
No, we specialize in non-resident matters only. If someone who's a local Canadian comes to us, we say work with someone locally because it's a very niche area of tax. And most Canadian accounting firms, they never deal with the non-resident items. Yeah.
We have a question from Facebook.
Yeah.
Does the $24,000 rebate only apply if the investor got the property rented?
Yeah.
What if they sold it via assignment?
That rebate of tax is if it's rented.
Okay.
So one thing I need to add to this is CRA has just come out with an anti-flipping tax. So yeah, generally speaking, and that's going to start now in 2023, anybody who sells a property within 1 year, even if it was your principal residence, it's going to be taxed. There's no principal residence exemption because people want to stop assignments, stop flipping. And as a realtor myself, as a broker myself, I don't often recommend my clients to assign properties because the CRA is really starting to crack down. People were assigning properties and not declaring any sales or their income. Now, CRA is connecting with builders. It started happening in BC, Vancouver. They're looking over who the transferees have been. They're going back to those individuals and they're going to try to recoup that tax. So if someone's assigning a property, CRA likely is not going to see it as a capital gain also, meaning it's not going to be taxed at 50%. It's going to be taxed at 100% as business income. So I try to stay away from assigning, and there's a lot of tax implications. And if you're a non-resident assigning property, technically there's a certificate of compliance requirement on top of that as well. Yeah,
I don't know, I'll just ask the question, but if a refugee buys property, do they still pay 25% land transfer? I think yes, but we might. but not
I
sure.
can't
Well,
confirm that, but
yeah,
they should
but-
talk to the lawyer, and the lawyer will likely have to register land transfer tax unless they're a first-time home buyer and they qualify first-time home buyer transfer rebates.
Different.
Yeah, that's all right.
My question is kind of outside when we're talking.
That's okay.
Just wondering if you know the maximum contribution for TFSA for this year.
I don't have that off the top of my head, but what I recommend is everyone sign up for an online My CRA account. You can access your previous notices, TFSA room, RSP contribution room. A little tax tip about TFSA. If anyone decides to move from Canada, escape to Hawaii and live there for a few years, when you become a non-resident, you can no longer contribute to TFSA. You have a penalty of 1% per year, and the penalty keeps going until the money is withdrawn from that account. So that's a little tax tip. Yeah. Yeah. So 360 Global Tax, we help individuals across the world from all over Canada. Like I said, with Departure, but also our special realty tax division. So if anyone ever has any questions or concerns, or a client who's looking to move or lives overseas, we're very, very happy to help. It's our area of expertise. And we're actually members of the Canadian Business Council of Dubai and North Emirates as well, and joining across the world. So we're growing, and thank you, everyone.
Thank you.
Yeah, thank you. I know I said a lot. It was a lot of tax talk.
Excuse me, is your fees, is it income tax deductible as well?
Yes, so accounting fees are tax deductible against the rental of a property or a sale of a property as well. Yes, you're welcome.
I'll let you guys ask more questions. I'll just sign off with these guys. Awesome. All right. Okay, guys, thanks so much for tuning in online. If you guys have questions and you didn't get Ruby's contact, just message one of the Fulton sisters. We'll help you out. I will have this recording on YouTube as well. So if you guys do want to go back and watch anything or go back to her slides or anything, just keep an eye out for the YouTube channel. So we're going to sign off for all of our virtual people, and we'll stick around for questions for our in-person. Thanks, Ruby.